Hi guys, welcome to another episode of Finance Talk, where we speak about finance, business, and investing. I'm Eugene. I have more than 10 years of experience in business. I also interested in finance and building my own portfolio and hoping to set up a fund in the nearest future.
And I'm Nick Rational. I too have a lot of business experience and been doing the investing for a while now. Together, we're going to share with you what we have learned, and together we can all learn more and become greater investors. I too hope to start a fund in the near future, and let's all learn together.
So, what will be our today's topic, Nick?
All right. So today's topic, I would say, would be ways that we can predict when a market crash or correction, or perhaps a challenging time period is coming, and we should be sitting in cash and ready to buy the great deals that come. We'll go through all the different indicators and different metrics to look at, and hopefully you guys can find value in that. So some people say that to look at for a market crash or correction, one should keep an eye on the Shiller PE, that if it's above 30, it might be a time to be cautious. What do you make of that one?
Yeah, I think that this is one of the most important indicators, but I think that we shouldn't just only rely on that, because Shiller did all his and most of his calculations when there are certain different situations on the market. And currently we are like the global village. Everything which just started, for example, in China or in other different countries, can actually have their world scale. In this case, we need to look at, I think, multiple indicators in order to understand the whole picture.
I'm so glad that you phrased it the way you did, because that's how I feel about the next indicator in a slightly different way, but similarly. So this next one is called the Buffett indicator. How it works is it's the US centric indicator. So it's the market cap to GDP ratio. So the GDP is that of the US. And when you look at the market cap of the US stock markets to the GDP, the ratio you get, that tells you whether it's overpriced or not. So if it's like 70 to 80%, it's great for investing. 100% is get ready for a crash. And it's over 192% for quite some time now. So a crash is coming according to this indicator. But just like Eugene said, the world has changed since these indicators have come around. And I think it used to be a good indicator because the GDP of the United States and the companies' earnings, all that was very correlated. But now you've got foreign investors plowing money into the US stock market, which pushes the prices up and alters things quite significantly. And yet you get companies in the US stock market that is foreign companies, and it's gotten very messy. And I think it's not as good an indicator as it once was. But that's my opinion. What are your thoughts on the Buffett indicator?
But I also want to say that we as value investors need not only to rely on macro, but we need to rely on microeconomics. And by that, I mean, we need to really understand the business. If we really know that the business is protected, the management is fine, we bought it at a decent price, way below its intrinsic value, and the market cap is suitable for us, we are really protected.
I absolutely agree. And I'll add that the reason we look at these indicators at all, and I personally don't look at them much, but the way it works is there's this kind of build up towards a crash or correction. And at that time, when things are all overpriced, it's very hard to find deals. Famous investors have famously said, there's just no deals today sometimes. And so we look at that and we go, it's not going to be like that forever. There is something on the horizon. It's going to be a crash. And as Warren Buffett says, it's better to go out with a bathtub than a thimble when it's raining gold. And that's what happens when there's a crash. Suddenly everything's on sale and you get to buy all the wonderful companies that you put on your wish list. And so that's why we look at these indicators and we try and figure out, is now a good time to be sitting in cash as much as possible? Or is it just am I not looking hard enough for the deals? So if you're struggling to find deals, you look at the indicators, and sometimes that'll help you to feel better about the fact that you're not seeing deals and know that it's going to start raining gold soon. What's your thoughts on that?
Yeah, and that's why most huge investors like Manish Pabrai, Guy Spear, and others, they go to different markets, the emerging countries, and they go, for example, like in Turkey or South Korea or Asia, where the prices are way low and the intrinsic value is much higher for particular companies. But anyway, in this case, by looking at these macro indicators, we do not try to predict the market, and we actually, no one knows what will be in the future with the economy, with the financial markets, with the companies, etc. But what we try to do is just to find some kind of trend, because there are a lot of indicators on the market, but the principles and psychological principles was and will be the same. People can vacillate between fear and greed, and in the long term, the market is the weighting machine. So when we can see, for example, now people are over optimistic about the prices, the capital is so easy to be taken from the banks and all other institutions, and actually companies can get overpriced and vice versa.
Exactly. Yeah, these are very interesting indicators, but let the viewer know that myself and Eugene actually don't look at these indicators very often. It's just more for your education and entertainment to know that they exist and to think about them and maybe even come up with your own indicators. And when you see how these indicators work, think about who came up with them and why do these indicators sometimes are accurate. And then you can maybe come up with your own indicators on a more micro scale, looking at a stock and going, perhaps I have something here that's a little bit more predictive, a little bit more certainty about where the stock is going. So the next one we're going to discuss is when the trend lines of the entire market as a whole are kind of matching up with a previous crash. If you were to overlay a previous crash's year or 5 years with the last 5 years, and you see that the market as a whole is doing almost the same thing, you can kind of get a feeling that maybe we're about to have a crash as well. So that's another idea that somebody came up with. I think it's a pretty good one because history does tend to repeat itself. You're seeing very close correlation. Maybe the market is doing the same thing. What do you make of that?
Yeah, and as I said previously, there is nothing new under the sun. So especially in psychology of people, you can actually go to the market and purchase the book, which is called Trend Watching by Ronin Sana. And he did really well understanding and analyzing the market trends and analyzing economic bubbles. In this book, he actually points out that everything is repeatable, and the economic crisis and all these bubbles have something in common. And all these patterns are actually the same. That's why when we look at the market and when we see the economic cycle and particular part of the cycle, we can actually understand or some kind of predict in a certain way the current trend.
That brings us perfectly to the next one, which is to do with the market cycle. So the Federal Reserve monetary policy effectively changes what is happening with the market cycle. So it's not a perfect money system that we have going. And to make sure that we don't have really bad crashes, they manipulate the liquidity of the money by changing interest rates, by lending out more money, by creating more money. They got like 5 or 6 different tools to kind of push what happens in the economy to try and smooth out things so that we don't have bad crashes like in 1929 and that kind of thing. And so effectively, I think they're doing a pretty good job considering it's a really complex thing. Considering humanity and psychology and all of that, when they do one thing of those 5 things, suddenly people will move their money to bonds, or they'll move it into property, or wherever it is that they think it's needed the most to prevent crashes. Effectively, for the last 100 years, they've got an average going of 7-year cycles, and so there'll be a sort of a boom and a bust and a boom and a bust, but it'll be very smooth rather than a big crash. When you see that it's gone past that 7-year amount, you're overdue for that correction. Currently, we are on year 12, 13, or 14. We're almost double the usual amount. That certainly means perhaps there is a correction coming. What are your thoughts on that?
We still do not know whether it will be this time or maybe there will be some amount of time needed for the correction or the drop down. But I agree with you that Fed does quite a good job in order to prevent such economic situations, and they try to pull the money into particular asset classes in order to make all this situation easier, I would say.
Which leads us on to the next one. It's something that a lot of you people who like statistics is going to like, because statistics can kind of be relied on in a lot of cases, at least with a certain degree of certainty. And how this one works is, if you look at all the crashes in human history, and there's more than you'd realize, there is on average, 41% crash for the market every 8 years or so. We haven't had a crash for 12, 13 years or so. So we're overdue in terms of statistics. And then similarly, for corrections, there's a 10% or more correction every 1.84 years, and we're overdue for that as well. Although I do think the market right now might be displaying a bit of a correction. What are your thoughts about following statistics like that?
I just read about that, but I'm not taking it into consideration because I focus primarily on the companies. Even in the US or Europe or different countries like Turkey, the inflation and all the macro can be not so fine, but there still be great opportunities with investing. You can just go through all these micro, middle cap companies. You can find the perfect company which suits you. As far as this company is really great, the management is great, you are protected from these negative events. You can actually hedge yourself from the economic downturn by just picking up the companies which can benefit from this crash. So, for example, when the Fed increases the rates, the real estate market can benefit from them. If there is something happened with the logistics, companies who produce inside the US or inside different countries can benefit from them. So you just need to thoroughly analyze everything, and you just need to connect the dots between the possible outcomes and the next actions which the crowd or the market can take.
I like that. What I find reassuring is that when you look at the market as a whole and you see that it's fairly consistent in that it has crashes from time to time, you can look at companies and see that they do the same thing. It's not as apparent with companies because you have the price line, which is very much affected by popularity in the short term, and it comes to being accurate quite regularly, but it's often popularity in the short term. It's a weighing machine in the long term, as Eugene said. It's a good quote from, I think it was Warren Buffett. If the market as a whole has regular crashes, so do these companies. So even if you think to yourself, my favorite company is Google. I'm not saying that Google should be your favorite company, I'm just making it as an example. But it's always so overpriced. Every time I do a discounted cash flow analysis, it's over that. I'm never going to get it down at a 50% margin of safety. Never mind, I can probably never get it at a fair price. But the truth is, all companies have crashes and corrections, and at various times their price and market and their intrinsic value, their true value, will line up. And so knowing this, you just put that on your wish list and you keep monitoring it. You'll eventually get your company at the price you want to get it, providing you're being reasonable, a good valuation, a good margin of safety. Even companies like Apple, just in the last few years, they hit a good margin of safety, and right now I believe Facebook has done it as well. So don't fear when you look at these high prices of all the companies you want to buy. Just like the market, they correct, and so have faith. You might have to wait 5 years, but if you've got 20 companies, you won't have to wait 5 years because one of those companies or two of those companies every year will hit the prices that you want to buy at. What are your thoughts on that?
Yeah, and as soon as you have this wish list of stocks and you are patient enough, I think that it is very realistic to make 20-26% per year, because when you have the combination of factors like different events, economic downturns, etc., they spoke about this in our previous episodes, you can get the discount for the particular stock. So in this case, you can just jump in the right time and receive the decent gains.
I think now would be a good time for me to briefly explain why 26% is the goal, why it's reasonable, and why that percentage. It's not just random, it's not just some wonderful percentage. The primary reason that I can see that it's a reasonable percentage to expect is that if you're buying something at a margin of safety of 50%, and you know why it's worth that 100%, you've done a good valuation, the market should recognize it at that price, and then you're getting it at a 50% discount. All you have to do is wait for the market to realize its mistake and get back to 100%. And when it does that, you've doubled your money. And if you can do that within 3 years, 100% return over 3 years is approximately 26% per year average. And if you're using an event that you know will harm the price, not the value, if you know it's going to harm the price for about a year, or at least be corrected within 3 years. So you want it to be over a year in harming the price and under 3 years in harming the price. If you can be relatively certain of that, you'll get that double, and that's the 26%. And I think that's a very reasonable percent to aim for every time you make an investment. There are other methods of investing where you're looking for maybe a longer scope and a bigger amount of doubles. So you could be like, I'm looking for a 20 bagger or a 10 bagger. That's where you're really compounding instead of just a 2 bagger, which is what a double is. But and there's all sorts of different ways of looking at it. But effectively, most of us are looking at a sort of a 26% is more than reasonable. If you can do better than that, fantastic. If you can even do 15%, you should probably, on a long-term scale, confidently, you should probably be managing other people's money, and they will beat down your door to invest with you. And that's the truth, because the market as a whole and 95% of money managers are only doing 8 to 10%. So if you can do 15, you're already way ahead of everybody else.
So this is the end of this episode. We hope that you really enjoyed it. And if you have any questions, please write them down in the comments below. Also, please subscribe to our channel for more videos, and see you next time.